Microsoft Corporation, ticker symbol MSFT, is currently trading at $432 a share. They have just released their latest earnings and things have gone pretty well. We'll just quickly talk about them now. Revenue up to $65 billion, increased 16%. Operating income $30 billion, increased 40%. Net income as well, up 11% to $24.7 billion, and diluted earnings per share $3.30. So that has increased quite a bit. So what we're going to be doing is looking at my automated stock valuation spreadsheet, see if it is a buy or a sell using the discounted free cash flow model, the comparable company model, maybe even look at the dividend discount model, as Microsoft do pay a small dividend, and of course finally the Ben Graham formula for intrinsic value. But we want to quickly go through the earnings here. So this was the CEO, Satya, was saying AI-driven transformation is changing workload, artifacts, and workflow across every single role, function, and business process. We're expanding our new opportunity and win new customers to help them apply our AI platforms and tools to drive new growth and leverage. But this was actually not the main thing that was looking good for them. There was a lot of growth in cloud. But what we'll do here is we have the income statements. We have the 3 months ended of 23 and then the equivalent time of 24. We can actually see revenue from products is down slightly, but service and other up about 10 billion. This is why the total revenue is up about 9 billion, 65.5 compared to 56.5. So that is excellent. Then we want to look at the income. As said before, it is up as well. This was 27 billion, now up to 30.2, and then obviously net income 22.2 to 24.6. Earnings per share, we saw that increase $3 to 332, or 299 to 330. Next, we will have a look at the cash flows. If I just scroll down here, where is it? Yeah, net cash from operating activities, free cash flow, of course, net cash from operations divided by capex. And it's increased 30.5 to 34.2. And capex, which is just a little bit down here. Where is it? Additions to properties and equipment, 9.9 to 14.9. So capex is up, as you can see, but with these stronger net cash operations, free cash flow, which, well, they haven't wrote it down. I have to calculate it in my head. Son of a gun, Microsoft. 34 minus 16. You guys can do the math on that one. But let me just go back here. And we do have some interesting... Yeah, there you go. See, cloud, 22%. 365 products up. Commercial cloud up. Commercial cloud and product service up. Cloud consumer up. LinkedIn up. Everything is up. Cloud is looking good. Azure 33. Lots and lots of changes year over year. So that is excellent to see. So what we'll do now is take it to my automated stock valuation spreadsheet. What I will do here is we will put in the ticker Microsoft, MSFT. And this will load all the latest company financial data. But because we have this updated stuff right here, we can now do some calculations and put in the updated number. So let's just let this load. 300, wow, that'd be a great price. $432 a share, 3.2 trillion in market cap, P of 36, which the market average is 29. That is very good price for a growth company like this. $11.80 a share, a beta of 0.9, meaning it's less volatile than the market, and analysts do say it is a buy with $495 a share. Do pay a dividend, 0.78%, meaning you will get paid $3.37. Buy your shares before then to get paid your quarterly dividend, and it's a very safe dividend, 30 to 50% in terms of net income and free cash flow ratio. So I have this up on my other screen, but we'll just put in the numbers here. So we saw that the let me go on this other screen. The total revenue increased to 65,588. So you can see there the net income. I just didn't do that, so you can see with the updated trailing 12 months up to 24 billion. Next, we want to add in the net income, which I believe was around about 24,667, and you can see net income is up almost 4 billion in the trailing 12 months. And then we'll add cash flow from operations and capex. I don't have to do the maths. Cash flow operations was 34,200, sorry, and then the capex 15. I've rounded these slightly, But anyway, what are you going to do? 19 billion in free cash flow. So let's just see. Yep, you can see that is up 69.9 billion. Very nice indeed. So revenue, we'll quickly blow through this. All-time highs, steady growth as well, actually, if you do look at this. Not slowing down one bit. When we look at these bigger companies, when, for example, I was looking at Tesla, you can see the revenue dropped off. AMD, it did as well. Microsoft going from strength to strength. Net income, similar story again, all-time highs, 90 billion. Sorry, I'll just say that number before. Revenue, 243. Profit up. Free cash flow, yep, 69.59. And also, if we look at the CapEx and operating expenses, we've got operating cash flow in the blue, CapEx in the red. CapEx is up, but the cash flows are still coming in, meaning the free cash flow is increasing. Shares outstanding, they are slowly buying back shares, rewarding shareholders through that way. So let's get into the discounted free cash flow model. So we're valuing companies, looking at their future free cash flows and discounting them to today's value. Looking at averages, $220 a share. Let's see if we can tweak this and see if we can get a fairer price. So we're expecting 260 and about 295 billion in revenues. Analysts are a little bit more bullish, actually, 318 in 2026. So what we'll do is we'll put this up to the current year, 13.82%. Oh, I put a comma in there. That will break everything. You can't put commas in. $250 a share. Next, we'll look at net income margins. You can see the net income margins are increasing, so we'll be a bit bullish here. Let's say they can continue to increase that. Let's put it at 37.5. $263 a share. And finally, we have our net free cash flow to net income. Really at the highest they've ever been is 77%. $288 a share on the discounted free cash flow model. So overvalued according to this, but normally yes, they don't like it. But look at the free cash flow is generating 69 billion. 200. It's growing and growing and growing. For this to be sort of fairly valued, we probably have to have much higher revenues, much higher net incomes. I mean, even then, 320, and probably somewhere in the region of, even at 100%, say 415. So yeah, discounted free cash flow does not normally like these stocks, but you can see even when it doesn't like it, it's still trending in the right direction. We'll quickly look at the dividend discount model. Also, if you're interested, please check my Patreon. Links are in the description. But we have the expected growth rate. The average growth rate currently is around about 10%. And the WACC, we need to put this a little bit higher. I mean, yeah, even if they continue growing at their current value, intrinsic value would be slightly less. But it does show that this model is kind of indicative of the actual price, 375. Okay, so let's have a look at the Ben Graham formula for intrinsic value. This looks at earnings per share, PE of a non-growth company, AAA bond, corporate bond. Currently, I believe we're still at 4.68. I do check this every time, but one day it'll change, but it hasn't changed in a while. And let's see what analysts are expecting for growth. 15%, we'll say. I don't think this is going to be a buy. No, 260, actually pretty close to what the discounted free cash flow model was showing. For them to be a buy, they probably have to grow at about 30%, which is very, very high for a company of this size. So finally, let's have a look at the comparable company model. This is a way of valuing companies looking at competitors of similar sizes, industries. We're looking at revenues, growth rates, EBITDA, net income, profit margin, price to sales, price to book, PEG, EV to revenue, EV to EBITDA, PE, and forward PE. So I would say Apple, Google, and I mean Amazon, AMZN. And what this will do is it will load all the latest company financial data for these companies as well. Now, unfortunately, with the Amazon comparison, a lot of their revenue comes from obviously the e-commerce side, but really that brings down their profit margin, things like that. So it'd be nice if I could just compare against AWS, but well, what are you going to do? So enterprise value, Microsoft second highest. Bottom in revenue 240, 380, 326, 600. 5-year growth rate of revenue pretty high, but not as high as Amazon and Alphabet. Profit margins, highest profit margins by far, 37%. So price to sales, price to book, it's actually the highest apart from Apple, which doesn't seem to be returning, and PEG on the higher side as well, with Alphabet and Amazon being lowest. EV to revenue, EV to EBITDA, PE, and forward PE gives us sort of an average price of somewhere in the region of $350 a share. So interestingly, all models saying it is not a buy. But if you're thinking this stock isn't a buy, I'll just quickly bring up the 5-year chart, up 200% in that time. up in the last year 28%. So obviously it was down from its all-time highs, about 7%. But if we were to compare this at the market, no surprises. It'll probably beat the market in every horizon, apart from more recent ones. Actually, you can see there, yeah, trailing slightly, but 200% over the last 5 years. So a heck of a stock in closing. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already, and catch you guys next time.